In the world of investing, numbers tell a story, but only if we know how to read them. Let's take a journey back in time and explore the tale of four companies, each walking a very different path in the financial markets. Our four players: a solid electrical equipment manufacturer, a fast growing air freight forwarder, an unglamorous yet consistent industrial machinery firm, and a diversified electronics company. At first glance, they seem similar, all listed on the same stock exchange, all active in manufacturing or services. But when we dig into their numbers, a very different story emerges. Two of these companies were priced modestly, with price to earnings ratios below 12. The other two, trading at 30 and even 45 times their earnings. Why the massive gap? Was it purely investor hype? Not entirely. The highly priced companies had shown rapid recent growth. Investors were chasing momentum. Earnings were expanding, and expectations were high. But here's the catch: high price doesn't always mean high value. All four companies showed profitability, but one company stood out, delivering massive earnings relative to its book value. Another boasted steady, uninterrupted growth for more than a decade. Yet, when the economy turned in 1970, the two glamour stocks, those with the highest valuations, took a hit. Meanwhile, the modestly priced companies remained remarkably stable. One company had paid dividends since 1902, yes, over 70 years without a pause. Another had no long-term debt at all, and the value stocks? They had strong balance sheets, conservative capital structures, and consistent cash flow. These weren't flashy businesses, but they were dependable, the kind that conservative investors quietly build their portfolios around. In the roaring bull market, the glamour stocks soared, some increasing 500 times from their lowest prices. But when the tide turned, the same favorites crashed hard. One fell over 70% within just 2 years. Many who chased its growth were left with losses they wouldn't recover for decades. Meanwhile, the quieter companies kept compounding steadily. Never headline makers, but never heartbreakers either. So, what lessons can we learn? The market rewards growth, but punishes overpaying for it. True investment success comes not from excitement, but from evaluation. The smart investor asks, is the company financially sound? Has it paid consistent dividends? Are its earnings growing reasonably? And am I paying a fair price? Two of our four companies met these standards and offered quiet strength beneath modest valuations. In the end, value lies not in popularity, but in performance, not in stories, but in substance, not in what's fashionable, but in what's fundamentally strong. Invest wisely, choose value, let history and careful analysis be your guide.